Good morning. My name is Bill Hulse. I'm joined here by Professor Angel from Georgetown University. I'm the policy lead at the Center for Capital Markets Competitiveness for Bank Policy. Professor Angel is a Georgetown University McDonough School of Business, where he specializes in financial markets policy. He recently released a paper talking about how small business lending has decreased in response to the Basel III capital regime being implemented in the United States, and also discusses some of the regulatory concerns he has with the Dodd-Frank Act. As we know, banks need to hold a sufficient amount of capital to cover their losses. However, as we also know, and the Chamber frequently pushes back against, is that overly prescriptive capital rules lead to an inefficient allocation of capital and hurt small business lending and access to credit in the United States. The Chamber has worked with its members to educate policymakers, and we're very excited to talk about some of Professor Angel's work. There's been a lot of anecdotal discussion over the years about the negative consequences of Basel III and the Dodd-Frank Act. If banks are constrained in their ability to make loans to small businesses, these small businesses are constrained in their ability to invest in the capital and labor necessary to grow. As we all know, small businesses are the fabric of our economy. Professor Angel certainly knows that they're important for creating jobs, and they are the focus for economic growth. I'm personally excited about Professor Angel's paper because it makes the connection between the capital rules and access to credit and what that means for our economy. With that, I'm going to let Professor Angel talk about some of his work, some of his findings, and some of his recommendations, and hope to have a discussion over the next 10, 20 minutes or so about how we can implement some of these changes in Washington and why they're so important.
Thank you, Bill. What I've been looking at is the relationship between the bank capital requirements and small business lending. And quite frankly, Washington, we've got a problem. Let's pull up the first chart. As you can see, what we have here is a chart which shows the number of loan originations and the dollar amount of lending to small businesses. And guess what? It dropped. It started dropping even before the Great Recession. It fell off a cliff in the Great Recession, and it hasn't recovered. No matter how you measure it, bank lending to small businesses is down. Let's look at the next chart. The next chart looks at bank lending to small businesses as a percentage of our overall economy, as a percentage of GDP. Once again, it fell off a cliff, and it really hasn't recovered. We've got a problem. Now, this is a serious problem for the U.S. economy because, as Bill mentioned, small businesses employ roughly half of our workforce and create the majority of our new jobs. These are the engines of our future economic development. If small businesses can't get the money they need to grow, then we have fewer jobs, less economic growth. That is a serious problem. So why is this happening? Well, a lot of this is an unintended consequence of some very well-meaning attempts to shore up our banking system. They're called bank capital requirements. Now, most of you know how banks operate. They borrow money from depositors and other people, combine it with some of their own money called their capital, and then they go and they invest it. They lend it to businesses, they lend it to consumers, and they also lend it to the U.S. government, putting it in safe things like U.S. Treasury bills. It's a good business, but the real question is we want to make sure the banks are safe. So these things called capital requirements would say, banks, you have to hold a certain amount of your own capital relative to the riskiness of your assets. And this is where the Basel Committee on Bank Supervision comes in. Now, the Basel Committee is an international group that basically it's a bunch of central bankers that get together and they come up with the bank's capital requirements. The idea is we want to have harmonized requirements around the world so that one country is not at an advantage or disadvantages to others. Nice idea in theory, but again, these capital requirements are not part of a treaty. They are not ratified by the Senate. They are just agreed upon by a bunch of central bankers and then implemented in various ways in different jurisdictions. So one of the things that has occurred is they have a formula where they apply risk weights to different types of loans. And unfortunately, loans to small businesses are put in a penalty box where they get a higher risk weight than they should have. That's a problem. Then we have the issue of not only how do you measure the riskiness of the assets, but how much capital do you have to have? And again, this is a hotly debated topic. And we only have 45 minutes. I could go on for 45 hours on this one. So Bill, if you have any questions, feel free to jump in.
Sure.
Otherwise, I can put everybody to sleep with a real quick monologue, and I don't want to do that.
Sure. I think we can just start off by, if you could distinguish between the capital and liquidity requirements out of Basel III and what those means for financial institutions.
Oh, yes. Well, like in the infomercials where they go, and there's more. Yes. There's definitely more to bank capital requirements. Not only are you required to hold a specific amount of your own capital, a certain amount of that has to be in so-called high-quality liquid assets. Well, let's think about how banks work. They borrow money and then they invest it. Now, when they invest it in loans, they're not liquid. When they invested in that loan to a business to expand, when they invested in that loan to a consumer to buy a car or a house, it's not something that they can easily turn around and sell. So when you say high-quality liquid assets, you're basically saying you have to take some of the money that you borrowed and you can't lend it out for real economic development. All you can really do is park it in something very safe and liquid like treasury bills. Well, the whole purpose of the banks really is to be making loans. Investors and consumers on their own can buy all the treasury bills they want. There's no real reason why we should be forcing banks to hold large quantities of them. Indeed, this is the reason why we have a Federal Reserve System in the first place, so that if a bank does need to borrow some liquid assets, they can borrow them from the Fed. That is why the Fed was created. That is basically the job of a central bank. But we've created this liquidity coverage ratio, which basically says, okay, banks, yes, you've borrowed a lot of money, but you can't lend it out to businesses that want to grow. Instead, you've got to park it in treasury bills. That is really a mistake.
So can you help draw the connection between holding a significantly higher amount of capital for small business loans compared to some other loans like mortgages, and what that means for lending to small businesses and what that means for Main Street?
Well, what it means is if you're a bank and you have a choice of where you can lend your money, if you stick it in treasury bills like you're required to for that liquidity coverage ratio, you're not required to hold any expensive capital against it. But if a small business walks in and says, I'd like a loan to help me grow the economy, it's going to be a much more costlier for you to fund that loan. Because not only will you be paying the interest on the money you've borrowed, you also have to hold more expensive capital against that loan. But there's more. It gets worse. There are the official risk weights that are applied under the so-called standard approach. But then we have the effective risk weights that our regulators have piled on top of that. Because we have, as part of our bank supervision process, we have things called stress tests. Now, this is an idea that's, it's a nice common sense idea. What we want to do is look not only at how much capital the banks had yesterday, but we want to look forward in some pessimistic adverse scenario and say, will they have enough capital in place to weather the next storm? So the largest banks are required to go through this massive paperwork exercise to estimate what the losses will look like if the economy falls off a cliff. And then the Federal Reserve, in a super secret star chamber process, looks at this and says, this is how much capital we think you're going to have in the adverse scenario. Well, if you reverse engineer what the output of those stress tests look like, how much capital the Fed thinks the banks will have compared with the inputs, it turns out that small business loans are really being placed in a very serious penalty box, where the effective risk weight that is applied to small business loans is far, far higher than it really should be. This is a problem. Now, I hate to say that we should follow the lead of the Europeans. I mean, as an American, that really galls me. But they looked at what the Basel Committee did, and the European Parliament basically said no. The European Parliament basically said, hey, wait a minute. Yes, we understand the need to raise capital requirements, but small business loans were not responsible for the Great Recession. So the European Parliament basically said, European banks, we're going to specifically apply a lower risk weight to small business loans. And that's one of the reasons why the Basel Committee harumphed and said, oh, the Europeans are materially non-compliant with our standards. Well, they did it in the right way. It was a common sense thing. The small business loans were not responsible for the Great Recession. There's no reason why small businesses should be penalized for the sins of others.
Is it fair to say that the Federal Reserve and our banking regulators here have actually implemented the Basel Accords in a more restrictive way that has been recommended? And what's that mean for U.S. competitiveness with other jurisdictions like the EU?
Oh, absolutely. They've gone on record in many cases and said, hey, this is stricter than what's required by Basel III. Now, there's a problem here. Banks compete globally. So if you tell our banks they have to hold more capital than other banks, what you're basically saying is our banks can lend out less. So that means our banks are at a competitive disadvantage to their foreign competitors. But since most businesses tend to borrow from banks in their own country, what we're saying is, oh, we're going to be more restrictive with our banks, so our banks will lend less. That means our businesses borrow less. Our businesses have less access to capital.
So, I mean, just taking this one step further then, does this potentially put our economy at an overall comparative disadvantage to the EU as well?
Oh, absolutely. That by making our banks adhere to standards which really are too high, what we're doing is we're putting our banks, our economy, our economic growth at a disadvantage to others.
Right. So you make a lot of recommendations in your report. We talked about the stress tests a little bit, about how we can right-size some of these capital and liquidity rules and at least tailor them a little bit so we can improve small business lending in the United States and really try to turn around some of the drop-off we've seen since about 2007, 2008, like you discussed earlier on. So let's talk about stress tests a little bit more. Can you talk about how they interact with some of the other capital rules and maybe some common sense reforms the Fed could think about to make small business lending a little bit easier for our financial institutions?
Exactly. We've got to take small business loans out of the penalty box. So we really need to rethink how we do the stress tests. Now, the stress tests are a great idea in theory. That, let's just sort of look into our crystal ball in the future and see what's going to happen in bad times and make sure the banks are strong enough to withstand it. It's a common sense idea. But we also need to look at the details much more carefully and say, wait a minute, are small business loans really that risky? Well, they didn't cause the Great Recession. Other things did. So we also need to think about the impact on economic growth by pulling back on lending right at the trough of a recession. Now, that's one of the things that went wrong in the Great Recession, that because of the way the capital requirements are put forth, when times get tough, in order to maintain your capital requirements, banks basically are going to cut back on lending. And here's why. That when the economy hits some turbulence, projected losses are going to go up. Okay, that means banks have lost some money. That means the amount of capital they have goes down. Now, in order to keep their capital ratio high, they basically have two choices. Choice number one is they can go out and raise more capital. But it's pretty hard to sell stock when the economy is in the trough of a recession. You're not going to get a lot for it. So banks aren't going to want to do that. The other thing they can do to raise the ratio, remember the ratio is basically the amount of capital relative to the risk weights on all their assets. Well, they can push the ratio up by reducing the denominator, by reducing their risk-weighted assets. And that means less lending to small businesses.
So in this case, how do the stress tests interact with the stress capital buffer or a potential countercyclical capital buffer like we've been reading a little bit more about in the press recently?
Okay. Well, as always, the devil is in the details. One other detail is a thing called the countercyclical capital buffer. The idea is you make banks store up money in good times, store up capital in good times, and then you let them draw down on that buffer in the bad times. But unfortunately, in order to pass the stress test, the banks have to show really that they're never going to breach that buffer, even in an adverse scenario. So instead of being a buffer that can be drawn down upon, it becomes a permanent buffer. And the banks know this. Even though in theory it could be drawn down, they know that in practice they will be under a lot of pressure not to let that capital ratio go down, even in the trough of a recession. So again, this is where the devil is in the details. If you look at how these are being applied in practice, they're really saying that you can't go into these buffers even in an adverse scenario. That's the problem.
So in theory, if the countercyclical capital buffer were to be required, how would banks go about raising that capital? One, how is the Fed going to coordinate with other jurisdictions so that the United States isn't at a comparative disadvantage like we've talked about? But two, isn't that a significant amount of capital to raise in such a short time period, and how expensive is that going to be?
Ooh, well, raising capital is always expensive. But the first part of the question is, let's get back to international cooperation. What this requires is a lot of good, close cooperation with our allies. The people we're having trade wars with, the people we're having tariff battles with, can we expect them to coordinate and follow our lead when we're being rather uncooperative in other areas? That could be difficult. So in order to get this to work as it should work in theory, people have to respond quickly enough and at the right level at the right time. But the problem is, as we've so often seen with regulation, is regulators often respond after the horse has left the barn. That it takes time for them to notice that there's a problem. It takes time for them to agree on a solution. It takes time to implement a solution. And by that point, not only is it too late, again, it's pro-cyclical. So that by the time this higher counter-cyclical buffer is actually put in place is probably when the next recession will have already begun. And by the time they get around to saying, okay, you can draw it down now, that's probably when we're already at the trough of the next recession. So in other words, that lending capacity won't be there when we need it the most.
That's pretty frustrating. There's a lot of talk about and a lot of understanding that maybe larger, more complicated banks should be subject to different capital requirements than small or medium-sized banks. However, what does that mean when we subject them to higher capital requirements? For example, what's the significance of the GSIB surcharge? And does that translate back to Main Street? Does it mean a decrease in small business lending potentially?
Absolutely. So the GSIB surcharge is to say, okay, for the biggest banks, we'll make them hold even more capital. We'll put them through even more stringent stress tests. Well, the recent Bill 2155 is a step in the right direction because it reduced some of the stress testing on the smaller banks, but it's still there for the largest banks. So we still really need to make sure that we get the capital requirements right for the largest banks. We also need to make sure that the largest banks don't have special penalties on small business lending. So that, yes, it's great that we've gotten rid of some of the stress testing problems for the smallest banks, but the biggest banks, guess what? They're the biggest part of the economy. And we don't really want to set up a situation where our largest financial institutions really don't want to make loans to small businesses anymore. So we need to make sure that the effective capital requirement for a small business loan is appropriate for a big bank and for a small bank. So we can't ignore the biggest banks. We've made some real serious progress on fixing the problem for the smaller banks, but we cannot declare mission accomplished and go home. We basically have to say, hey, wait a minute, we still have a problem here. We still need to look very carefully at how we apply these stress tests to the largest banks. We need to really think about the GSIB surcharge. We need to really think about the liquidity coverage ratio. We really need to examine the details of the impact of our well-meaning capital requirements really on the economy, on what it's doing to the small business loans that really are the lifeblood of our economy.
Yeah, so to that point, I'm glad you mentioned 2155. As you know, there's been a change in, I would say, the leadership in Washington with the election of Donald Trump and some of his appointees being put in place that are independent financial regulators. A lot of the rules that you've been discussing were implemented by President Obama's appointees. We now have a change in leadership of these regulators, I think many of which are eager to at least review some of the post-crisis framework. Some of them have talked about maybe tailoring some of the regulations a little bit, and I know that's something the Chamber and its members are very excited about for all the reasons you just discussed. Do you have any thoughts about where the regulators should maybe look first? What do you think are some of the most important things they can be looking at as they're talking about prioritizing, some of the most important changes?
Right. Well, the first step in dealing with a problem is recognizing you've got a problem. So I think, the first step is to say, hey, wait a minute. Okay, we really need to pay attention to how are all the things we're thinking about affecting the supply of capital to small businesses. When we're in situations where, even by the Fed's own studies, a very large fraction of businesses with good credit ratings are having trouble raising capital. That's a problem. So the first thing we've got to do is admit we've got a problem. And the capital requirements, and especially the effective risk weights on business loans, that I think is really the first thing to look at, to say, okay, why are the stress tests being so punishing to small business loans? That, I think, is really one of the very first things. And
sorry to interrupt, but the
Yeah.
Fed already had a lot of this data in hand, or they've already looked at a lot of this, and they just decided it wasn't important, or it wasn't worth it, or that they wanted to provide a stronger weight for overall economic stability. Or do you think they overlooked some of these details?
I would not be surprised. History has shown that the Fed has overlooked many details over the years. And they may be so focused on, we've got to be like generals fighting the last war. We must make sure that no financial institution ever gets to a point where they might want to borrow money from us. I mean, they're really trying to abrogate their job. The job of the central bank is to be the lender of last resort. And they want to set the capital requirements so high that no bank ever needs to come to them for a loan. That, I think, would be a mistake, because we really need to think, there are extremes. If you don't have any capital requirements, that's a problem. Too many banks will fail, too much damage to the economy. On the other hand, if the capital requirements are so high, then we have no lending, we don't really have the capital that the economy needs to grow. So there is a golden mean. We've gone too far in one direction. We now need to sort of find that golden mean. And I think that is a very important thing to say, okay, we really need to re-examine the stress tests and their impact on small businesses. We need to look at it not just for the smaller banks, but also for the larger banks as well.
That's really helpful. So I think, as many of our viewers know, Senator Crapo's bill, S-2155, was signed into law by the president earlier this summer. And it talks about a lot of the things that you and I have been talking about today, specifically readdressing some of the enhanced prudential standards for small and regional banks, and also leaving them room for tailoring for larger institutions as well. At this point, though, I think there's just not a lot of clarity about how this law is being implemented. I mean, so far I've seen what I would say the Fed doing is batting some singles. They've done some interim final rules on where the statute was most clear. They changed the risk weights for some municipal securities for the liquidity coverage ratio. I know there's a lot of municipal issuers who are happy about that, for the same reasons that small business issuers would be happy about that if we were changing the risk weights for some of the rules you were talking about. It's the exact same thing in principle for the LCR. They've changed the small bank company policy holding statement. They've changed the examination cycle for some institutions. These are all great, but they've really not addressed the bigger picture issues around some of the Basel III framework and the Dodd-Frank rules and where they plan to go there. I think there's just a lot of frustration right now about what those next steps might be. Randy Quarles made a speech earlier this summer. I don't know if you had a chance to read that, but he noted that that asset size isn't the only indicator of risk. I think there's general agreement around that, and that we should look at things like interconnectedness and the types of activities financial institutions are involved in. But most importantly, he provided maybe a little bit of clarity on a timeline. He said he recognizes that S-2155 gives him 18 months to reassess this capital framework. However, from there, we don't know where we're going next. And I think there's a lot of frustration at this point. There's a lot of things that we hope the Fed will talk about and the Fed will consider that you raise in your report, and something that I know that hopefully they're taking under consideration. But at this point, we don't have a lot of clarity. I guess as an academic, if you were in the room with Vice Chairman Quarles or Chairman Powell, what questions would you have for them?
Ooh, good question. Well, the first thing I'd like to point out is that the Fed is a very slow, cautious, conservative organization. I've spent a lot of time with the Fed working on their faster payments task force, and they definitely move slowly. The first question I would have would be very direct. When are you going to take small business loans out of the penalty box? What actions are you taking to specifically look at the impact of your well-meaning capital requirements on bank lending to small businesses? What can you do to fix this problem? I think we need to be very direct and say, hey, you've got a problem here. This is going to be a long-term problem for the economy. We're going to have less economic growth. We're going to have fewer jobs if we don't allow banks to make loans to small businesses. So the question I always ask is, what are you doing to fix the problem? What are you doing to address the risk weights for small business loans? What are you doing to address the liquidity coverage ratio? Now, as a large institution, we can't lose sight of the fact that the Fed was a discussant in the Basel Committee. They have a big influence there. So a large part of the Basel capital requirements are things the Fed agreed to. So as an organization, they're going to be very hesitant to say, well, we didn't quite do things right. No organization likes to admit, oops, we made a mistake. But I think we have to look at the impact of what's been happening and say, okay, we really haven't solved the pro-cyclical nature of bank capital requirements. We have a serious problem here with lending to small businesses. Let's fix it.
So when we're talking about some of those pro-cyclical concerns, and as the Fed thinks about some of these changes and also thinks about maybe some changes in monetary policy too, are you concerned that our existing capital framework could maybe worsen the next recession? And just if you just look at the business cycle, it's probably somewhere in the next 1 to 5 years, and that's just how the business cycle tends to operate. So what are your thoughts around that?
Absolutely. We have not fixed the pro-cyclicality of our capital requirements because we want banks to have enough capital to withstand the bad times. That's common sense. But when the economy turns down, if we're forcing them to maintain a too high level of bank capital, the way they're going to do that is they're going to respond to the incentives that we have given them with our bank capital requirements, and they're going to cut lending across the board to small businesses, large businesses, consumers. So even good creditworthy people will have trouble getting credit in the next recession if we don't fix the bank capital requirements.
So there's some urgency around this.
Yes, because the bull market has been going on for a long time. We probably are somewhere near the peak of the current business cycle. We know inevitably there will be another recession at some point. We don't know exactly when. My crystal ball is always pretty cloudy. But one thing I can see pretty clearly, if we don't fix bank capital requirements, we're going to have serious problems in the next recession.
That's incredibly helpful, incredibly insightful. At this point, I think we're prepared to turn to some questions.
So if you have questions for Bill or Professor Angel, you can use the chat function to text a question to us. We have our first question. It's for Professor Angel. What are the most important reforms? What has the biggest bang for the buck for increasing small business lending?
I think the biggest bang for the buck, again, is to reform the risk weights applied to small business loans so that they will no longer be in the penalty box they're in now. So the European Parliament basically explicitly gave lower risk weights to small business loans, lower than the Basel capital standards require. But we're in a situation where in the US we have higher risk weights, and the effective risk weights that we have from our stress tests are even higher. So we need to make it really clear to the banks that small business loans will be taken out of the penalty box, and the message needs to get out.
We have one last question directed to Bill. When do you expect the Federal Reserve will provide some clarity about how they will tailor regulations?
That's a great question, and as I said, there is not a lot of certainty at this point, other than to say that Governor Quarles, the Vice Chair for Supervision at the Federal Reserve, gave a speech a couple months ago where he acknowledged the importance of addressing what Congress called for in the adoption of S2155. He acknowledged that there's pretty much an 18-month timeline for the Federal Reserve to come up with a new framework for enhanced potential standards. He noted that this is something that he believes the Fed can get done in 18 months, and he's really eager to get done more quickly. The next step would be to do some sort of proposed rule or request for information. It sounds like they're going to go in the direction of a proposed rule, but that's something that has not been made available to the public yet. Additionally, the banking regulators are scheduled to testify before the Senate Banking Committee next week. This will be an opportunity for the senators on that committee, who worked very diligently over really a number of years to come up with S2155, to get a little bit more transparency from the banking regulators about the direction they plan to go, but also to make sure that the law is faithfully implemented. This is the purpose of oversight hearings, and I know there are a lot of people in Washington, and probably a lot of people on Main Street too, who are eager to see what those next steps might be, and when we're going to have a little bit more easing of access to credit for small businesses in our country.
Again, if you have any questions for Professor Andrew or Bill, please use the chat function to ask your question. We're not seeing any additional questions. Would you both like to make final statements?
Sure, I'd be happy to do that. Again, I'd like to thank Professor Angel for his work on this report. It's something that's been very valuable to the Chamber and its members, very insightful, and I know something that's already been very well received by policymakers. Anything from you?
Thank you. Well, it is a pleasure to work on this very important topic. I think it should be near and dear basically to every American. We have a problem here. Our capital requirements have the unintended consequence of throttling back lending to small businesses. And again, this is the engine of our economic development. We need to make sure that engine is well taken care of. So I want to thank all of you for your attention all the way through this webinar. It means you're engaged in this topic, as you should be, and let's keep the engagement up. Thank you.
I'd like to thank all of our viewers for joining us, and if you'd like to learn any more about our work, you can go to centerforcapitalmarketscompetitiveness.com. Thank you.